We all see what's going on, right? Record gold prices, every analyst and headline telling you why it's happening, but hardly anyone is asking what it actually means. Because behind the headlines, there's a massive transfer of wealth already underway. But it's bigger than money. It's about settlement. The East is taking possession of the world's collateral while the West keeps trading promises. For the first time in half a century, the global balance sheet is shifting, and not through growth, but through collateral. The assets that underpin confidence in the financial system are migrating from paper to metal, from claims to settlement. And the East is taking possession of the world's last unencumbered asset, the one that settles without permission. But while the West keeps trading on promises that still are built on credit and counterparty. Today's video is very much inspired and informed by a recent interview with the brilliant Alistair MacLeod, and it really got me thinking, and I saw it as a great opportunity to sit and talk about what this shift in the gold price and movement means for the world economy, because this is more than about de-dollarization or impending financial collapse. Gold's rise beyond $4,000 an ounce is not a speculative oddity, but it's the accounting record of that movement. In the West, collateral is still defined by the contracts that represent it, but in the East, it's measured by weight. And the result is a quiet inversion of financial power, as nations once content to hold promises are choosing instead to hold the means of final settlement. Now, in India, this transformation is personal, it's tangible, it's deeply cultural. Economists at Morgan Stanley estimate that Indian households now own around 34,600 tons of gold, an amount worth roughly $3.8 trillion, and equivalent to the nation's annual GDP. Now, this wealth that exists outside the reach of the banking system, a form of savings that requires neither leverage nor counterparty. And when the gold price surged by more than 50% this year, the appreciation did not enrich a class of speculators, it repriced the balance sheet of a society. And the Reserve Bank of India, well, it's responded in kind. It's lifting its own official holdings to about 880 tons, close to 12% of total forex reserves. A decade ago, that proportion was roughly half. The central bank's actions reflect the same principle that guides its households. Security lies not in liquidity, but in the ability to convert promises into substance. And across the Himalayas, China's approach has matured from accumulation to architecture. Having spent 2 decades building its own hoard, while Beijing is now constructing the infrastructure through which the world may store and trade bullion. The Shanghai Gold Exchange, long the core of domestic trade, has begun extending its reach overseas. A new network of bonded warehouse and offshore vaults is designed not simply to handle imports, but to invite other nations to place their reserves within Chinese jurisdiction. The objective is clear: to make Shanghai an alternative to London as the centre of physical gold custody, thereby complementing New York's dominance of paper assets with a Chinese counterpart in tangible wealth. This institutional development continues a policy that began quietly after Mao's death. Between 2000 and 2024, China became the world's second largest net buyer of gold, adding more than 1,800 tons, second only to Russia. As of mid-2025, gold accounts for about 6.7% of China's official reserve, a figure that understates its true position given the state's control of domestic mining and refining. Over time, China has been exchanging US treasuries for gold, a substitution that represents a profound change in the nature of its collateral. China has been exchanging treasuries for bullion for years. Every ton added to Beijing's reserves represents not only a reduction in its exposure to US debt, but a withdrawal of trust from the entire credit structure built upon it. This isn't a portfolio adjustment we're talking about. It's the replacement of paper collateral, because it is at once an economic and a psychological shift. It's an acknowledgement that in a world of sanctions, currency weaponization, fragile property markets, the asset that settles without permission is the asset that endures. Yet this transformation in official reserve also mirrors a much older cultural reflex. In countries such as China, India, and other BRICS nations, gold has never been a curiosity or a hedge. It's a necessity embedded in household behavior, collective memory, if you like. For populations that view gold not as an investment but as a prerequisite of security, well, the state's moves from treasuries to bullion is not about a revolution. It's more about a return to heritage, a return to the norm. The broader BRICS bloc is following a similar trajectory. Its members are seeking to conduct a growing share of trade in local currencies, and for that system to command credibility, they require a neutral form of collateral. Gold provides it. The Shanghai Gold Exchange now offers yuan-denominated contracts that may be settled in cash or in physical delivery, linking China's currency directly to a universally recognized measure of value. It is a small but significant re-engineering of global finance. While the West continues to create claims, the East is constructing the architecture to redeem them. Global central banks are reinforcing the same trend. For 3 consecutive years, their combined purchases have exceeded 1,000 tons annually. This is the highest sustained rate of official accumulation in history. And the motivation is pragmatic rather than ideological. Holdings of US Treasuries among foreign central banks have fallen to their lowest level in more than a decade, while the dollar's share of world reserves has slipped to a 20-year low. What we are witnessing is not a coordinated assault on the dollar, but instead a collective move towards assets that cannot be devalued by decree. Now, the logic behind this shift is ancient. Gold represents final settlement. Fiat currencies represent deferred settlement. Payment in gold extinguishes a debt, whereas payment in credit merely transfers it. Modern finance blurred this distinction, building a civilization of leverage on the assumption that deferred settlement could be rolled over indefinitely. Whereas the East, informed by longer memory and a keener sense of vulnerability, is quietly restoring the hierarchy that history demands. Settlement before speculation, collateral before confidence. China's preparation for such a moment stretches back 4 decades. MacLeod tells us that in 1983, the People's Bank of China was formally charged with acquiring and managing the nation's bullion and silver reserves at a time when private ownership of gold remained illegal. Now, for nearly 20 years, while Western central banks were leasing their reserves into the market, Beijing accumulated quietly. When private ownership was finally legalized in 2002 and the Shanghai Gold Exchange opened, the policy simply evolved. Gold could flow into China through imports and mining, but it could not flow out. The mechanism was designed to be one way. Now, MacLeod estimates that China's combined state and private holdings now approach 75,000 tons, close to 40% of all above-ground stocks. Much of what Western investors consider market liquidity has therefore migrated into a system from which it's unlikely to return. And when this rebalancing finally becomes visible to Western households, it may feel less like an economic event and perhaps more like, to use an overused word right now, a reckoning. For generations, the West has been conditioned into believing that its systems, its finance, its education, its medicine were the inevitable evolution of civilization, while the East traditions were relics of a slower world. Yet it is the so-called provincial nations, once enlisted to manufacture the West's prosperity and to finance its deficits, that have accumulated the only collateral that matters. The comparison is almost domestic. The child who once worked in the family business now holds the savings, while the parent, having consumed too much and saved too little, discovers that prudence has migrated eastward. And the lesson is an uncomfortable one, but it's not unfamiliar. Those who mocked the discipline of others must now live by their own indulgence. What distinguishes the Eastern approach is that it unites policy with culture. In the West, gold is regarded as either an antique or an extravagance, useful for diversification perhaps, but fundamentally out of fashion. In the East, it remains the cornerstone of security. The divergence is not sentimental, but civilizational. The West still defines wealth by yield and liquidity, whereas the East defines it by insurance and convertibility. It represents a broad recollateralization of global wealth, a movement from financial abstraction back to tangible assurance. None of this presages the imminent collapse of the dollar or the dramatic return of the gold standard. The world remains too interlinked for such abrupt transitions, but the direction of travel is unmistakable. The fiat experiment launched in 1971 is approaching its natural limits. Each expansion of credit demands an ever larger suspension of disbelief, and each crisis exposes the fragility of a system built entirely on trust. And gold's ascent is not about a symptom of speculation, but it's about this measure of reconciliation between value and reality. The distinction can be summarized quite simply. The West continues to believe that value can be created by decree. The East insists that it must be stored before it can be spent. And when the next liquidity event arrives, the advantage will not lie with the country that has the deepest markets, but with the one that holds the most credible collateral. And that, in essence, is the great flip, a global realignment of wealth from paper to metal, from promise to settlement. The movement of gold from west to east is best understood as a rational response to the exhaustion of leverage. As confidence in financial promises erodes, the societies that never abandon metal appear less archaic and more prescient. Gold's $4,000 price is not a symptom of mania, it's an assessment of the system. The East didn't triumph through innovation or disruption, but through memory. In the long history of commerce, promises have always multiplied faster than the assets that secure them. Eventually, the world remembers the difference. And if you're looking for your own physical collateral, why not click on the link below, book a strategy call today, and speak to our member of our team on how to get started.